Muniz. I'm a partner at Sobel and Company. I would like to welcome you to Sobel Insights. Sobel Insights is a weekly series where we provide some brief information on various topics. Our goal is to keep these sessions to 15 minutes. At this time, we don't offer CPE. I'm asking you, if you have any ideas for topics or speakers, please let me know. We want to make these sessions as interesting to you as possible. So please feel free to reach out to me anytime. Our topic today is benefit plan changes. Our speaker is Jamie Polak. She's a manager in the accounting and auditing department, specializing in employee benefit plans and audits and other consulting services. So Jamie, I hear that there are some changes to the contribution limits for 2022 that are coming up. Is that right?
That's correct. So effective 1/1/2022, if you are in a 401k plan or a 403b plan, the salary deferral limit increased to $20,500. This is an increase from $1,000 from the 2021 limits. However, if you're 50 years or older, you're eligible to defer an additional $6,500 of catch-up contributions, which did not change from this past year. So if you're 50 or older, the total amount you could defer is $27,000 for 2022.
That's interesting that they didn't increase the 55 and over, or 50 and over group, 50 and over group. I was thinking 55 because of me, but that they didn't increase that 6,500, but they increased the other side. Okay.
It's also weird because they did not change the traditional or Roth IRA limits. Those remain the same from 2021. So those limits are deferring up to $6,000, and for the catch-up contributions, if you're over 50, you can defer an extra $1,000. So it's a little weird that they didn't change those. However, if you're in a simple IRA, they did change the deferral limit to $14,000, which was previously $13,500. But again, did not change the catch-up contributions. So those are $3,000 if you're in a simple IRA for those 50 and older. So total, that's $17,000 that you could put away in a simple IRA if you're over 50. A couple other changes that they made to the annual limitations. If you're in a qualified defined contribution plan, that total increased to $61,000. That means if your total employee and your employer contributions cannot exceed that threshold, that does not include your catch-up contributions. So you can still put away that extra amount if you are. They also made some changes to the highly compensated thresholds for compliance purposes. That increased to $305,000, and highly comp employees increased to $135,000. There are some other changes as well, but for those you could talk to your accountant, or there's also information on the IRS website if you want to get any more of the limits.
Great, thank you. These are inflationary adjustments to, they're trying to encourage people, especially the 50 and over group, that are getting nearer retirement. And that's why they add that additional, only 6,500 now. I guess I didn't lobby hard enough.
Yep.
Only 60 or the 6,500, they're encouraging that group to make sure that they're stable enough for retirement not just relying on Social Security.
Yep.
And the plans that you pretty much mentioned, or the plans that you talk about, are known as defined contribution plans too. We're not addressing any changes here as it relates to defined benefit plans. These are defined contribution plans. In addition to the individual IRA, Roth and regular IRAs that you talked about. So, so I want to make sure people know that. And that's for employers to express to their employees. And if you're an employee, you should be able to change your contribution limit if you're at the max. Good for you.
Yep.
So what employees, Jamie, what employees don't know, or employers don't know, is if their plan reaches a certain limit of eligible participants. Even I just got it wrong. Eligible participants. If there's a certain number that the plan would require an audit.
Yes. So this could be your defined contribution plans or your defined benefit plans. So any qualified employer-sponsored benefit plan that's subject to ERISA could be required to have an audit if they reach over 120 eligible participants in the plan. So that's not just participating, it's you have to look at your eligibility rules and determine who could be eligible, even if they don't want to be, in the plan, those people are counted towards the requirement for an audit. So that's the reason why IRAs typically don't get audited, because their threshold for participants is under that 120 limit. So usually it's just going to be your 401k plans, 403b plans, defined benefit plans, health and welfare plans that you'll see having audits. The one exception to this is the Secure Act that came out, that passed, that's effective for 1/1/2021, allows for unrelated employers to join a pooled employer plan, which everyone calls Pep Plans now. These are still subject to audit. However, they could fit under the new exemption audit rules if they have less than 1,000 participants, and each individual employer in this PEP cannot exceed 100 participants. So if the PEP goes over one of those rules, then they're required to have an audit. If you're under those thresholds, then don't need one yet, but you could have one. So that's the only exception right now. Once you're considered a large plan and have an audit, you're required to have an audit every year until you reach under 100 eligible participants. And then you can file a short form for your Form 5500 and then no longer need an audit. So once you hit over that 120 threshold, you still need an audit until you're under 100 eligible in any subsequent year.
That's interesting about the 1,000 employees. I wasn't familiar with that, or eligible participants. Keep saying employees. It's not an employee count, and it's not active participant count. It's eligible employees.
Eligible, yep.
Right. So we actually had a client one time that was a transient type of business where it had a lot of day laborers coming in, and they were automatically, and they were documented where they were employees of the company. And as soon as they joined, they were eligible to participate. And they had under $1 million in assets, but they had over 1,000 eligible participants. Yeah. And they were not happy with us when we told them that they had to have the audit. But that's the thing. You have to be careful with your plan design. You're not a plan design expert. We've had plan design experts on here, but they should talk to people about their plan design to make sure that it's meeting the minimum requirements, which you talked about in my first question, or the maximum, meeting the maximum requirements, and that they're having the audit done. Now, it's also part of the audit, a part relating to reporting requirements, is certain plans have to file, or not certain plans have to file with the IRS. And I believe it's a Form 5500.
Yes. Yeah. So
when does it need to be filed?
So the annual report, so if you're considered a large, well, regardless, the Form 5500 is due on the last day of the 7th month that the plan year ends. So for most plans that have a December 31st year end, the due date is July 31st. So if you are considered a large plan and need an audit, as I just mentioned before, then the annual report needs to be included in that filing, versus if you're under that threshold, you don't need an audit and you're filing a short Form 5500, but the due date's the same. You can request an extension that's Form 5558. This is an automatic extension, which could extend the due date another 2.5 months. So again, in my example, if you're a 12/31 plan year end, which would normally be due on July 31st, you can extend automatically an extra 2.5 months to get you to October 15th as your due date. So it's a popular question that I get.
Which is why I see you going crazy right around October 15th. And everybody thinks that's just a tax deadline. Well, it is. It's a Form 5500. It's an EBP tax deadline, but it requires you to have your audits done. So
yes.
Now, if a company went through an audit last year, that audit of their EBP finance statements, is there any particular changes that is going on this year that they should be worried about?
Yeah, so there's actually a couple of changes that I want to go over. So one of them, in the past, if you had an audit, you would either be subject to a full scope audit or a limited scope audit. This terminology has now changed to full scope audit being an ERISA audit, and a limited scope audit is now an ERISA Section 103A3C audit. Now, there's a lot of talk in the industry that we're trying to come up with a nickname to try to shorten that, but it's a mouthful. But for now, that's That's kind of the best that we've got. So most of the testing has not changed. There was just some clarity that was put out in SAS 136 that I'll talk about, and some changes to Form 5500, including like some compliance questions that they asked. But for the most part, it's very similar audit. So a full scope audit, if you had one in the past, there was testing that was done on the investment information. If you had a limited scope audit, it's because you obtained a certification from your bank, insurance company, trust company that certified the investment information, which allowed the auditors to not perform certain testing around investments, realized gains, losses, fair market value testing at the end of the year. That's all the same. It's just the name change. So then SAS 136 came out, and which has been updated and codified in AUC Section 703, which is effective for plans ending on or after December 15, 2021. This standard addresses auditors' responsibility to form an opinion on the ERISA financial statements, the form and content of the auditor's report, and some of plans management's responsibility related to the audit. So if you did have an audit, I really recommend before the audit begins, making sure you talk to your auditors to understand the responsibility that you will have before the audit starts. So some of the key changes in AUC Section 703 is new engagement. One of them is new engagement acceptance preconditions. So in the past, auditors kind of were responsible for making sure that an audit was permissible under a limited scope audit, but now an ERISA Section 103A 103A3C. I know it's a tongue tie. So now management is responsible to make sure that an audit is permissible under ERISA 103A3C. Management's also responsible for understanding the certification. For example, if it's reported under a GAAP basis, if it's another accounting basis, if you have certain investments that are at fair value or contract value, if all of the investments are covered under the certification, or if you need to obtain multiple certifications, if they're from a qualified institution. Management must also acknowledge that they need to be able to provide auditors with a substantially complete Form 5500 before the audit report is dated.
Before it's dated.
Yeah, before it's dated. So now
Okay.
you can't just review Schedule H. You need to make sure that all of the required forms that are in there that would have a material effect on the financial statements, both qualitative and quantitative, needs to be in there. So qualitative is making sure your fees are in, your Schedule H ties out to the financials. The qualitative piece is those compliance questions, making sure the auditor's report section is filled out correctly, some of that stuff. Management's also responsible for making sure they're maintaining current plan documents, maintaining participant records adequately, and making sure that they're administrating the plan under current plan provisions. So before the audit starts, and you'll probably see some changes in your audit engagement letters, all of this needs to be addressed and communicated with your auditors kind of before the audit begins. A lot of this was being done before, but like I said, it's just making sure that management's responsible for it. Some other key changes that occur is making sure that you're testing the relevant plan provisions and making sure it's included in your risk assessment. This includes eligibility, timing of your contribution deposits, allocation of contributions, etc. So you want to make sure you're testing all key plan provisions. There's also some guidance in there about auditors' communication, making sure reportable transactions and reportable findings are communicated to those charged with governance in writing, which could include noncompliance, some control deficiencies, and making sure it's done on a timely basis. And the last key change is that you'll see changes in your audit report. Where in the past, if you had that limited scope audit, there was a disclaimer of opinion. Now the ERISA Section 103A3C will have an opinion in it, as well as some changes to the management representations. So. All in a
So-
nutshell.
So the audits are going to change significantly. And I guess in a nutshell, my last quick question for you is, what should the plan sponsor or management do to get ready for these upcoming changes? Just get in touch with their accountant and start talking with them about it?
Yeah, so that's number one. I would say talk to your auditors as soon as you can, because all these changes, and they want to make sure they have a good understanding of their new responsibilities before the audit begins. You could also have, significant or discussions about significant plan changes, internal controls. Start sending reports as soon as they're ready, payroll reports, census files, online access if they're going to be testing the record keepers report. So there's a lot that goes out early. You don't have to wait until July to get it started. So definitely recommend reaching out to your auditors as soon as you
Great.
can.
I appreciate all the information, because what it sounds like to me, if people, continued on, is that there's a lot being put on management now. They have a fiduciary responsibility, and there's a lot being put on management now. And
Mhm.
we as the auditors have to check that. But when I talk about management, I'm talking about the sponsors. So just keep up on this. If you are a plan sponsor in management, start talking with your auditors. You can call Liz Harper, bug her about it. I recommend that. Liz is really up on this stuff along with Jamie. So Jamie, I want to thank you very much for all this information. I'm sure that people are sitting there with their heads swirling around right now. Heck, I QC these and my head's swirling right now. But I want to thank you. I want to thank everybody for listening, and hope to see everybody soon. Thank you, Jamie.
Thank you.